Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to introduce to you the capital budgeting techniques. The following are the 4 common capital budgeting techniques or methods that we use. First, payback period. It means how long it takes for us to earn back the initial cost, the shorter the better. Second, net present value, NPV. NPV calculates the value of future cash flows in today's dollars. It helps assess the profitability of an investment or project. Positive NPV indicates a potentially good investment. Third, internal rate of return, IRR. IRR is a measure of the profitability of an investment. It represents the rate at which an investment breaks even. Fourth, Profitability Index, PI. PI is used to evaluate the attractiveness of an investment by comparing its potential returns to its initial cost. A PI greater than 1 indicates a potentially profitable investment. Among these 4 techniques, the payback period doesn't rely on the discounted cash flow technique, while the other 3 techniques, NPV, IRR and PI, are based on the capitalization of cash flows, which involves using the discounted cash flow technique. Calculating NPV, IRR and PI may require the use of a financial calculator. First, let's talk about payback period. You don't need a financial calculator as it's just a straightforward calculation. The payback period means how long it takes to get our money back. That's the number of years required to recover a project's cost. Project cost is what we call the initial investment or initial outlay. Your answer will be in years. How many years it takes to recover a project's cost? Let's take an example. Look at the timeline. Let's say initially you invest $500,000 in one project. After paying $500,000 at year 0, afterwards every year you will earn back $150,000 for 8 years. To calculate the payback period, we can apply a simple formula. Taking initial investment over annual cash flow, you will get the payback period. This formula is applicable only when you receive same amount of cash flows every year. For the calculation, we take 500K over 150K, you'll get 3.33 years. This means after investing $500,000, it takes 3.33 years to earn back the initial cost. Next, if we have a mixed stream cash flow, payback period can be calculated by adding project's cash inflows to its cost until the cumulative cash flow for the project turns positive. In other words, annual cash flow is accumulated until the initial investment is recovered. Let's take an example. You have $45,000 invested in year 0, and then year 1 you'll receive $28,000, year 2 $12,000, year 3 to year 5 $10,000 each. So how to calculate the payback period? Let's look at the answer. First, how to get 2 years. We just have to do a simple calculation here. First year $28,000 plus second year $12,000, you'll get a total of $40,000. That's how you get 2 years. Third year is $10,000, but we only need to recover another $5,000. $5,000 is calculated by taking $45,000 minus $40,000. Then, $5,000 over $10,000, you'll get 0.5 year. 2 years plus 0.5 year, you'll get a payback period of 2.5 years. Whether to accept or reject the project? Let's look at the decision rule. Cutoff is the maximum period that the company management can accept, and it is set by the company management. If the payback period is less than the cutoff, we'll accept the project. If the payback period is more than the cutoff, then we'll reject the project. If our senior management had set a cutoff of 4 years for the projects, what would be our decision? It depends on whether they are independent projects or mutually exclusive projects. If they are independent projects, then we can accept both projects. Refer back to the previous examples. Payback periods of the projects are 3.33 years and 2.5 years, so both are acceptable as their payback periods are less than the cutoff 4 years. If they are mutually exclusive projects, then we have to select the project with the shortest payback period. That's the project with 2.5 years payback period. Next, let's talk about the strengths and weaknesses of using payback period. First, payback period provides an indication of a project's risk and liquidity. Payback will tell you how long it takes to earn back your own money. That's how risky and how liquid the project is. Second, it's easy to calculate and understand the concept of payback period. However, payback period is subject to some weaknesses due to its simplicity. First, it ignores the time value of money. When calculating the payback period, we assume that the money received in year 1 is equivalent to the money received in year 2, meaning we do not consider the time factor. Second, it ignores cash flows occurring after the payback period. For the calculation of payback, we only care about how long it takes to recover the initial cost, but we don't care about how much money you will receive after the payback period. Third, it does not take into account any required rate of return, which is the interest rate. The interest rate is not considered when calculating the payback period. Lastly, cutoffs are subjective. Some companies may consider 3 years acceptable, while others may prefer 4 years. Why 3 years or 4 years? It entirely depends on the company's management. Next, we have discounted payback period. This method will be similar to the normal payback period, but it will include one more factor, that's the required rate of return. Discounted payback period discounts the cash flows at the firm's required rate of return. In other words, payback period is calculated using these discounted net cash flows. Same as the normal payback period, discounted payback period's focus is on the investment liquidity. It tells us how long it takes to earn back the initial investment. Although the discounted payback period already includes the required return, it is still not perfect. First, it still does not consider the time value of money. Second, it still does not examine all cash flows. The cash flows after payback are still ignored. Third, cutoffs are still subjective. How to set the cutoff year, how long to recover the cost of project is considered acceptable, these are still unclear. Let's take an example. The initial investment is $500,000, and then from year 1 to year 5, you're gonna receive $250,000 each year. To calculate the discounted payback period, you may follow this format that I'm gonna show you. In the first row, which is year 0, you simply need to write down negative $500K for the cash flow. In year 0, there is no need to apply any discount rate, so for the PV of the year 0 cash flow, you again write negative $500K. Year 1, cash flow is $250K. To get the PV of year 1 cash flow, we may use the financial calculator. By keying in FV equals negative $250K, IY equals 14%, N equals 1, you will get the PV of year 1 cash flow, $219.3K. Taking negative $500K plus $219.3K, the balance is negative $280.7K. We will still need to recover another $280.7K. Year 2, cash flow is $250K. Just follow the same way to get the PV of year 2 cash flow. Using financial calculator, key in FV equals negative $250K, IY equals 14%, N equals 2, you will get the PV of year 2 cash flow, $192.4K. We will still need to recover another $88.3K. Year 3, cash flow is also $250K. Using financial calculator, you will get a PV of $168.7K, which is more than the balance of $88.3K. So, we just take $88.3K over $168.7K, you will get 0.52 year. Add back the accumulated 2 years from previous calculation, then you will get the answer. The discounted payback is 2.52 years. Next, let's talk about net present value, NPV. To calculate the NPV, we take PV of the stream of future cash flows from a project minus the project's net investment. NCFT is the net cash flow at year T, N is the life of the project in years, K is the cost of capital, and ANV is the net investment, that's CF0. Specifically, cost of capital is the discount rate or required rate of return, or the opportunity cost, that's the minimum return needs to be earned. How to know whether the NPV is acceptable or not? As long as the NPV is greater than 0, or we say a positive NPV, then the project can be accepted. Businesses aim to accept projects with positive NPV to maximize value. If the NPV is less than 0, that's negative NPV, then we will reject the project. Another concern arises from the fact that various types of projects can result in different decisions. If the projects are independent, you can accept all the projects as long as they have positive NPV. It's simply because these projects do not compete for the firm's resources, that's why you can accept all. However, if your projects are mutually exclusive, you have to select the highest NPV project. Mutually exclusive projects mean you can only choose one, the best one. Next, let's look at the strengths and weaknesses of NPV. The first strength is that NPV is consistent with the goal of shareholder wealth maximization. NPV represents the intrinsic value of the investment, which in turn demonstrates the value of the company. The value of the company is the value of shareholder wealth. Second, NPV considers both the magnitude and timing of cash flows. Magnitude refers to how much, while timing is about when you will receive the cash flows. Third, it indicates whether a proposed project will yield the investor's required rate of return. If the NPV is positive, it shows that the return of the project is higher than the required return. Next is about the weaknesses of NPV. First, many people find it difficult to work with a dollar return rather than a percentage return. It could be challenging to explain the meaning of NPV, but it is easy to understand the concept of a percentage return. For example, a 20% return means that if you invest $100, you will receive $20 in return. However, with a positive NPV of $20, it is hard to explain how much you can earn from the investment. Second, it's hard to determine the discount rate as it changes over the life. Many factors such as economic environment and the capital structure of the company may affect the discount rate. The following is an example of NPV calculation. Suppose we are considering a capital investment that costs $550,000 and provides annual net cash flows of $200,000 for the first 2 years, $300,000 for the next 2 years, and $100,000 on year 5. The firm's required rate of return is 10%. Calculate the net present value. For this question, let's turn to the Financial Calculator app. We will use the IRR NPV calculator. Using Financial Calculator, key in the discount rate 10%, CF0 negative 550,000, CF1 and CF2 200,000, CF3 and CF4 300,000, CF5 100,000. Then just press Calculate, you will get the answers of IRR and NPV. Because the NPV is greater than 0, we will accept this project. Another useful indicator for capital budgeting is the internal rate of return, or IRR. IRR is the discount rate that equates the present value PV of net cash flows of a project with the PV of the net investment. That's the discount rate to obtain NPV of 0. In other words, IRR is the rate of return that makes the PV of the net cash flows equal to the initial investment. Technically, IRR represents the return on the firm's invested capital, or it is the rate of return that the firm earns on its capital budgeting projects. This concept bears a resemblance to our yield to maturity (YTM) formula for bonds. In fact, YTM is essentially the IRR of a bond. For the decision rule, if the IRR is greater than or equal to K, we'll accept the project. Here, K represents the cost of capital, specifically the weighted average cost of capital, WACC. If the IRR is smaller than K, then we'll reject the project. In terms of types of projects, if the projects are independent, you may accept all the projects as long as the IRR is greater than or equal to K. But if the projects are mutually exclusive, you can only select the project with the highest IRR. Let's look at the following example. Suppose we are considering a capital investment that costs $250,000 and provides annual net cash flows of $100,000 for 5 years. The firm's required rate of return is 15%. Calculate the IRR. Just as we calculate NPV, we're going to use a financial calculator to calculate the IRR. Simply input the following values: discount rate of 15%, CF0 is negative $250,000, and CF1 through CF5 as $100,000. Press the calculate button, and you will obtain an IRR of 28.65%. Since the IRR exceeds the required rate of return, we will proceed with accepting this project. Let's talk about the strengths and weaknesses of IRR. First, let's discuss its strengths. People tend to be more comfortable with IRR. As we mentioned in the previous section, when comparing IRR to NPV, people find it easier to explain the meaning of IRR since it is expressed as a percentage return. Next, IRR considers both the magnitude and the timing of cash flows. This aligns with the principles of NPV. It considers how much cash flows you will receive and when you will receive them, addressing both the magnitude and timing of cash flows. Now, let's delve into the weaknesses of IRR. The first issue is that multiple IRR exists when we deal with unconventional cash flows. Recall the concept of conventional versus unconventional cash flows. This situation occurs when there are more than one negative cash flow apart from CF0. Another challenge relates to the reinvestment assumption, which we will explain in more detail later. In short, IRR is a good decision-making tool as long as cash flows are conventional cash flow. If there are multiple sign changes in the cash flow stream, we could get multiple IRRs. Next, Profitability Index, or PI. Profitability Index is defined as the ratio of the PV of expected cash flows over the life of the project to the net investment, represented as NANV, where NANV is CF0. It can be interpreted as the present value of return for each dollar of the initial investment. The decision rule for the Profitability Index is as follows. If the Profitability Index is greater than or equal to 1, we'll accept the project. If the Profitability Index is less than 1, we'll reject the project. For different types of projects, if the projects are independent, all of them can be accepted as long as the Profitability Index is greater than or equal to 1. However, if the projects are mutually exclusive, then we can only select the project with the highest Profitability Index. Okay, let's work through this example. Suppose we are considering a capital investment that costs $250,000 and provides annual net cash flows of $100,000 for 5 years. The firm's required rate of return is 15%. Calculate the Profitability Index. Using a financial calculator, we will have 2 steps. Step 1, you will input the discount rate as 15%, set CF0 to 0. This is different from NPV. You shouldn't input the actual initial investment as CF0, but instead, set CF0 to 0. Then, for CF1 to CF5, input 100,000. This will yield an NPV of 335,216. This represents the present value of the future cash flows. Step 2. Divide 335,216 by the initial investment of $250,000. This will give you a profitability index of 1.34. Since the profitability index of this project is greater than 1, we will accept the project. NPV and PI are essential tools used by financial analysts and managers to evaluate potential projects. However, conflicts may arise between these two metrics, particularly in scenarios involving mutually exclusive investments. When alternative projects require significantly different initial investments, conflicts can arise between NPV and PI. For example, one project may have a higher NPV, while another project may have a higher PI. The final decision is often based on other factors, such as capital rationing. Capital rationing occurs when a company has limited funds available for investments and cannot undertake all projects with positive NPVs or PIs due to budget constraints. In such cases, the choice between NPV and PI becomes crucial. When there is no capital rationing and funds are unlimited, NPV tends to be the preferred metric. This is because NPV focuses on the absolute dollar value of returns and helps increase the investor's wealth. The project with the highest NPV is chosen because it contributes the most to the company's overall financial value. However, when capital is constrained, PI becomes more important. PI tells you which project can generate the most return per dollar invested. In capital rationing situations, where a company must make the most efficient use of its limited funds, projects with the highest PI are typically prioritized, as they offer the best return on investment. To compare NPV versus IRR, which one is a better measure? In fact, we would always prefer NPV. This preference arises from the different reinvestment assumptions of NPV and IRR. NPV makes no reinvestment assumption, therefore, the reinvestment rate will not change the outcome of the project. Alternatively, we can say that the reinvestment rate for NPV is the same as the cost of capital, denoted as K. However, IRR does make a reinvestment rate assumption, assuming that the company will reinvest cash inflows at the IRR's rate of return throughout the project's lifetime. It could be unrealistic to rely on IRR if the reinvestment rate is too high to be feasible. This reinvestment assumption can also lead to conflicts in ranking mutually exclusive projects. For example, one project may have a higher NPV, while another project may have a higher IRR. In conclusion, our investment decision should always be based on NPV, not IRR. NPV is superior to IRR when choosing among mutually exclusive investments because discount rate, K, represents a more realistic reinvestment rate than the computed internal rate of return. This is due to K represents the opportunity cost of capital for the firm. To address the issue of the reinvestment assumption of IRR, we apply another measure called Modified Internal Rate of Return, abbreviated as MIRR. MIRR is the discount rate that makes the PV of a project's terminal value, TV, equal the PV of its costs. TV is calculated by compounding cash inflows at the WACC, which is used to determine the future value of all cash inflows. Thus, MIRR assumes that cash inflows are reinvested at the WACC, making it a more realistic assumption. MIRR correctly assumes reinvestment at the opportunity cost, which is equal to the WACC. On the other hand, MIRR also resolves the problem of multiple IRRs. It's important to note that multiple IRR and modified IRR are two distinct concepts. Managers often prefer comparing the IRRs of different projects, and MIRR is a better indicator than the standard IRR. To calculate the MIRR, let's take an example. The net investment of a project is $100,000. Upon investment, it will bring in cash flow of $10,000, $60,000, and $80,000 in the consecutive 3 years. Calculate the MIRR of this project, assume a 10% discount rate and reinvestment rate. To get the answer, we'll use Financial Calculator. Inside IRR NPV Calculator, you'll find one function called MIRR Calculator. Enter the finance rate as 10%, the reinvestment rate as 10%, CF0 as negative 100,000, CF1 as 10,000, CF2 as 60,000, and CF3 as 80,000. After entering these values, press Calculate, and you will obtain the MIRR, which is 16.5%. As the MIRR is greater than the discount rate of 10%, this project is considered acceptable. Alternatively, you may apply a 3-step method to find the MIRR. Step 1. Find the NPV by assuming CF0 equals 0. Step 2. Find the terminal value of the cash inflows, that is the future value. Step 3. Equating the initial investment to the terminal value to find the interest rate, and the interest rate is the MIRR. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.